So basically, I will be speaking today about gold. As we all know that inflation now is the hot topics in the capital markets. We're talking about higher prices, we're talking about inflation, we're talking about central banks tightening the policies and raising interest rate to fight the inflation at the moment. So all the investors in the world, whenever they think about inflation and rising prices, they think about buying gold as an anti-inflationary hedge to preserve their capital or their money when inflation goes up. So here in this presentation, I will be proving to you that gold is not the best investment when it comes to high inflation. Like if we look here in the chart, these periods, 1940 until 1949, 1970, 79, 80, 89, these periods, they had a high inflation periods. And when we zoom in into this period, I would like to know what happened to gold at this time. Did gold rise or did it fall? So if we move forward and take only these high inflationary period, we can see that the gold is in yellow. We can see that only one time out of 3 times the gold yielded positive. That means with high inflation, gold rose up, okay? That means not every time we have inflation, we should buy gold. Now I will dig more into details and tell you why gold was not going up during high inflation period. So whenever there's high inflation, the central banks tighten the policies in order to make the economy less, the circulation of the economy, let's say, or the cash flow will become lesser than before, because when interest rates are higher, the lending and borrowing costs are higher. So the credit cards, the loans, everything is higher. So the companies, the international companies, the multinational companies tends not to take loans and expand their business. That means the economy tends not to grow. The GDP becomes, near zero, let's say. So when the interest rates goes up, the bond market becomes less attractive. Why? Because if interest rates is high, the bond market is a safe investment. Let's say the government bonds. Let's say 5 or 10-year government bonds. If I want to invest in these bonds, the bond market tends to give me a minimal return, but fixed and safe return, let's say. So the bond market is the best investment when it comes to safe investment, If the interest rates goes higher, so the bond market, because it gives me small return, it's not interesting anymore. Makes sense, yeah? The bond market is not interesting because the interest rates are higher. I can benefit more if I put my money in the interest rates or deposit it in the bank. I will not go invest in a bond market that gives me, for example, 1% return or 1.5, and the interest rates will give me 3 or 4 or 5%. Makes sense. So what happens to the bond market? It will go down, it will crash. And what goes up? The yield of the bond. So if we hear about the yields, 5-year yield or 10-year yields, it tends to go up. Whenever there's high inflationary period, the interest rates goes up, the yields start to go up of the bond market in order to make the bond market interesting again. So if we go and check at the moment, if we check the 10-year yield, we can see that the yields is trading near 4.5 and 5% because in order to make the bond market interesting. And actually, yields and gold, they have negative correlation. So whenever the yields go up, gold tends to go down, and the other way around. So, and this is the proof. If we go into history and check the yields of the bond market and we check gold, the red is the gold, we can see that whenever yields go down, gold go up, and vice versa, So inflation, high interest rates, bond market crash, yields go up, gold go down. This is a simple equation we need to know. So I as well do some, other than the fundamental analysis and all these news and all these technicals, I work technicals as well. I love Elliott wave. And other than Elliott wave, I use Fibonacci and combine them together. So sometimes we do charting and we do some analysis on the yields and on the bonds itself to see if we predict an upward movement in the bonds or a downward movement in order to see if we buy gold now or not. So whenever you want to buy gold, it's not only looking at the gold chart itself. You need some time to look at the bond market in order to see if you buy gold or not. At the moment, this is the 2 and 10 yield curve. It's trading like, this is an old photo actually. I will go into, this is gold Bitcoin before. And it's interesting to know that gold and Bitcoin have somehow positive correlation, knowing that Bitcoin is a decentralized market, should be, but now it isn't, and all the effect of the central banks are affecting the Bitcoin and the cryptocurrencies, and we can see here the positive correlation between gold and Bitcoin. I will go back into this before later on. So this is the inflation. It started at like 9.1 November, December 2022, and now it's almost around 3.5% in the USA. It's going down. Okay, so this is my analysis on gold. When we talk about Elliott waves, we talk about impulsive waves and corrective waves. When we talk about impulsive waves, we talk about 5 waves up. A corrective wave, it's a 3 wave down. This is Elliott wave, like big picture of it. So gold, when gold reached $1,040 an ounce, we believe that it started a new impulsive wave, which will take us or take gold towards new highs, which is 2,300, 2,400, maybe more. But the thing is that during this impulsive wave, we can see some corrective cycles in which, like if you go up wave 1, wave 2, go down wave 2, wave 3, which is the fastest, the longest, and it contains 5 waves inside of it. We can see that inside wave 3, there is as well 5 waves inside the wave of 3. So it's a tranche, okay, intermediate cycle, grand cycle, intermediate, smaller cycle. So $1,100 an ounce, 1, 2, 3, 4, 5, wave 3 is done. ABC as a correction when gold retested the 1,600 after the Russian-Ukrainian war and when we reached the $2,077 an ounce, and it didn't break through. So we went as a complex corrective wave, which is a 3 wave but complex in a WXY form. We finished the correction near 1,600 and we started now the wave 5. If you look into the red labeling here, you can see 1, 2, 3, 4, and now we're going up wave 5 in gold. So wave 5 in gold will reach new highs. However, wave 5 in gold is like wave 3. We might see inside wave 5, 5 small impulsive waves. So we rose wave 1 of 5, and you can see now gold, this is an old analysis by the way, and now it happened actually. So gold reached another time $2,077 an ounce, it didn't break it, and now went down near 1900s. I was expecting wave 2 to end approximately near 1840, 1825, and then we can see another impulsive wave. So at the moment, we are in wave 2, okay? It might be ending very soon, and we will start another impulsive wave, which is wave 3 of wave 5, that will take us to new highs. And here you can see that it's more clear, I think. So wave 4 down, near 1650, wave 5, it's 1, 2, 3, 4, 5, wave 1 of 5, A. Now we enter the triangle, which is B, and we might see another leg down towards 1850, 1840, which is wave 2, and another impulsive wave, wave 5. So yes, I'm long on gold. Why, fundamentally speaking, why gold might go up? So if we look at the tightening policies, we can see that inflation is going down, it's cooling. At the moment that Jerome Powell, like the Federal Reserve, fixed the interest rates, but at some times, because the environment or the economy doesn't like the high interest rate environment, because the business will tend to, the cash flow and the rotation will be very slow. So the Federal Reserve will at some time maybe in 2024, we can start to see the dot plot at the FOMC, and we can see that there is almost 2 to 4 decreases in the interest rates in 2024. So when the interest rates tend to go down, what will happen to the equation that we first said, the equation? The interest rates go down, the bond market will recover, the yields of the bond market will go down, gold will go up. So eventually, when the Fed starts to decrease the interest rates, we will see another impulsive wave of gold. And this is very normal, okay? So this is a combination between fundamental and technical analysis, Elliott waves, Fibonacci, some numbers, and some tightening policies talk. All right, so this is wave 2, okay. At the moment, we are near this number, by the way. So I believe, which is like A, B, C. It might be done. There is a scenario that gold might have bottomed here, and we're starting another impulsive wave, which is 1, small 1, 2, and now tomorrow we have core durable goods. Core durable goods tomorrow, Wednesday. I think we will see a bounce on gold, okay? I believe we will see a bounce on gold. I will be here at the expo, so you can visit me at the booth and we can talk about that. So I think tomorrow gold on core durable goods will rise. And, but of course not 2,650, but it will start a new impulsive wave if this scenario is done. If not, we can see 1980, 1970, 1980, and after that we can see another move downwards toward 1850 and 1840. But both ways, I think we can see this bounce towards 1978 or 1950, 1980 before any move lower that might happen. Okay, so this is another scenario, which is this is silver, basically. Many investors love silver, and they think that silver and gold tend to work together. If we go back in time, like 4 to 5 years ago, we see that yes, gold and silver used to work together, and the correlation was very positive, like near 89% positive. So almost 1 to 0.9, and that means whenever gold goes up, silver goes up, and vice versa. At the moment, because if we look into gold, let's say mining, if we look into Australia, why the Aussie dollar is called commodity currency? Because Australia have the biggest mines, okay? One of the biggest mines. So the Aussie currency, the AUD USD, tends to have a positive correlation with gold. So, but if we look at the moment, like there's not much mining happening, what's happening is a remanufacturing of gold. They are melting gold and remanufacturing gold again, and they are not mining a lot. So, and silver as well, they are using it with some technology, computers, blah, 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 I don't know how. Anyway, so silver is moving a little bit in a different way. I see that silver is in an impulsive wave as well. We rose 1, 2, 3, 4, 5, which is a first impulsive wave. Wave 2, gold went down into 1600, wave 2. Silver entered a triangular form, and usually in a classical pattern or in Elliott waves, the triangle tend to have 5 waves inside of it, which is A, B, C, D, and E. And basically the breakout will always be in the side of the D, okay? So if you have a trend up, the A will be down, B, C, D, E, and the D will be upward, correct? However, if you have a trend down, the A, the first wave of the triangle will be up, so the D will be down, okay? So always the breakout will be on the D side. So I think silver as well is near bottoming here. It already, when I did this chart, it was 2288. It already reached 2250, 60, I think. So it already touched this area. I believe that silver might have a very good bottom at the moment, and we might be as well starting another impulsive wave towards $30, $34 an ounce. It needs time. However, this is a possible, very possible scenario, because I do believe that there's no reason for silver to break down more. The US dollar now is stronger because the Federal Reserve, Jerome Powell, is saying that we might raise interest rates more in November or December, there's one more hike again. So this affects the dollar, and we are seeing at the moment a strong dollar, okay? This is the reason behind this fall. However, technically speaking, this is an important area. Okay, I don't know. I have 5 minutes. I can go back into some... like this is an interesting... this is an interesting slide, actually, but it needs more time. Anyway, but if you see this in front of you, and if I tell you at the moment, gold, since the beginning of the year, performed plus 19%, okay? And euro dollar plus 11%, GBP plus 10%, New Zealand dollar plus 7%, plus 1% Aussie dollar. What is the currency that you think, or the asset that you think it's good to invest in? Is it the high performance asset, which is the gold, 19%? You buy the one that is already going up, or you buy the undervalued currency, which is the Aussie dollar? What is it you think? The undervalued, the Aussie? Okay, like this is the psychology of the human beings. Like when we think about investment, we always look to buy things at a cheaper price. And we always want to sell these assets at a higher price. However, in the capital markets, it's not that way. When we look about investments, we look about different factors, different engines. What's happening in the market for gold to perform positively? What's happening in the market for Aussie dollar to not perform? There is something happening. The tightening policies in Australia is different than the tightening policies in the USA. There is at the moment something called policy divergence. Policy divergence is when the USA raise interest rates, however the other banks does not raise the interest rates as fast as the USA. What happens in this scenario? The dollar will outperform this currency. Okay? So when the USA rises rates fast, in a fast pace, and Australia doesn't raise the same rates, and even Japan, they still have negative rates, this affects the currency and weakens the currency against the US dollar. That means we are not in a good and healthy environment to buy this currency. So always look at the economical situation and do not look at the undervalued asset. I believe that the best investment at the moment here is either the medium currencies or the high outperforming, which is the gold. Not the other way around. It's a little bit of a psychology. This is my opinion. If you tend to invest long-term, 3 to 5 years, maybe the Aussie is the best investment, okay? But we're talking about, I don't think any of us will hold the asset for 5 years. I doubt. We're looking for fast profits, correct? Yeah. So we'll look into the higher performance asset. Thank you so much.